day.
Hims and Hers Health, ticker symbol HIMS, reported earnings today, and the stock, while being up intraday, was down 13.5% in the after hours after the earnings report. And we are going to talk about Hims and Her Health and is this a buy right now. But before we dive in, if you could please go ahead, like and subscribe. It really, really helps me out. Now, you guys know exactly what Hims and Hers Health do. They're just a telehealth company that offers online consultations with healthcare professionals and sells prescription and over-the-counter treatments for various health and wellness needs, primarily focusing on men's and women's health issues. They provide direct-to-consumer platforms where individuals can access products for erectile dysfunction, hair loss, skincare, mental health, weight loss, etc. A whole range of things that they just keep expanding their TAM. So you can see why the stock was down 13%, because the company missed on the consensus estimates here for revenue as well as the consensus EPS estimates. The street were looking for 21 cents and 551 million. Hims and Hers Health reported 544 million against 17 cents in earnings per share. There's nothing wrong with the business. It still grew 72% over the year, and earnings per share grew 200%. So there's nothing wrong with the business. Most of it pertains just to the valuations and the expectations leading up into this. Now, when you actually look at revenue on a sequential basis, yes, revenue did grow 72% from the same quarter last year. This would be the June quarter, so you can see a massive growth. However, sequentially, we actually saw a 9% decline here in revenue on a sequential basis. So from Q1 to Q2, revenue did fall 9%. And that was the first sequential decline in revenue since the company went public. Gross margins fell. That's not what you want to see. That could be indicative of pricing power, as well as a cost of revenue or operating expenses significantly higher than the actual revenue. Again, you don't want to ever see gross margins declining. It's often indicative of a loss of market share. Net income margins did increase to the company, turning profitable and really expanding margins. And you could see that. Look at net income dollars, went from 30 million to 42 million dollars from the same quarter last year. So massive growth right there. However, free cash flow margin did actually decrease, and they appeared in the negative 11.9%. And this largely has to do with some capital expenditures and acquisition costs that they took in the previous quarter. And we'll talk about that as we go. So for all intents and purposes, this free cash flow margin has to do with an acquisition. I think EBITDA and net income margin is a far better metric to look at with regards to this earnings as to the health of the overall business. Because at the end of the day, acquisitions do happen, and it does detract from free cash flow. And then when you look at the company's balance sheet, right? Company's balance sheet, they have $1.14 billion and they have $1.04 billion in debt. But we'll talk about their balance sheet a little bit later on in the video. So you can see here, revenue is up 73%, very solid. It was like 72.9% to be exact. Now, cost of revenue was up 117%. And this is what I was talking about before. Because the reason why gross margins declined is because cost of revenue was actually higher than the actual revenue. So by and large, your gross margin is going to be lower. However, the company continued to build very solid operating leverage in the operating expenses, only increasing 58%. And that largely has to do with cost controls with regards to selling, general and administrative expenses, as well as operations and support. And that is how we get a 219% increase in net income and a 200% increase in earnings per share after you account for dilution. Look, revenue is broken down into two real segments, online and wholesale. The wholesale is generally what they sell in stores. They sell like creams and stuff on the counter of stores like CVS, and then they have online revenue. This is their large growth driver. Online revenue makes up 90 to 95% of their total revenue. And you can see that grew 75% year over year. Wholesale actually fell 10%, and then total revenue was up 73% for the quarter. And then when you look at subscriber growth along with that, you can see here that subscribers at the end of the period, right, total 2.439 million. That was a 31% increase from the same time last year. So this is people using the platform growing 31%. So it really goes to show how they can get those revenue metrics of like 73%, net income up 200%, because at the same time as subscribers are growing, the average revenue per subscriber is increasing. That grew from $57 last year to $74. That's a 30% increase. So you have two levers being pulled here. Subscribers are increasing. They're getting more per subscriber. And that is how you have a company that's absolutely growing like a weed. You could see a growth of revenue 75% over the same time last year. Just incredible stuff. You can see this is what their subscribers look like on a chart just onward and to the right. And since about this time period right here, 2023, subscribers have 2x. This is truly a growth company and very, very impressive what the management team have done. Again, whatever the price action in the after hours was, this is a company that's just executing on all fronts, and you love to see that. And as an investor, you should be really happy with these results over the last 5 or so years if you've been invested in the stock. Now, looking at guidance, looking ahead, the management team came out and issued guidance. They said we're looking for $570 to $590 million. So 580 at the midpoint. The street were expecting 586 at the midpoint. So this was actually a slight guide lower compared to the consensus expectation. However, the company came out and said we're still looking for $2.3 to $2.4 billion for the full year. So 2.2 at the midpoint, and that is roughly in line with expectations. So they reaffirmed full year guidance and a slight guide lower compared to what the street was expecting here in Q3. And that was a big reason why we saw the stock fall. It really just had to do with this guidance. And then adjusted EBITDA of 60 to 70 million. You're looking at 11 to 12% margin. The current margin for EBITDA is about 7%. So you're looking at a business that's still going to grow 40% plus and expand margins into the double digit, potentially low teens range here by Q3, and definitely in the mid teens range by the end of the year, 13 to 14%. And you're looking at 50% growth. Depending on which side the management team comes in on their guidance, you're going to assume the midpoint, which is about 58, 59% growth in total. So you can see something that's very interesting to note, 85% long-term retention. Now, this was a bit suspect to me because I looked at this, you have 85% long-term retention. That is their underlying goal. So you could assume that the number right now is probably lower than that. So if you have 85% long-term retention and 30% revenue growth, does that mean that your subscribers are churning at about 50%? So does HIMS have a 50% churn rate that or maybe even less than 50%? That is not a very strong churn rate compared to something like SEMrush or ServiceNow, which has like a revenue retention rate of 114%. Very, very different business model right there. And they have a churn rate of like 1% to 2%. So it really goes to show software versus a company like this, you have a fairly high churn rate and a revenue retention rate of less than 100%, which means that at some point the music is going to stop for this business, especially with that high growth once they mature out. Now, they are expanding their portfolio of personalized offerings. They have strong unit economics with a payback period of less than 1 year after acquiring a customer, and the evolving model drives inherent market efficiencies, especially when you look at an online model compared to having a lot of brick and mortar stores. And then they also guided here for weight loss revenue of at least 725 million. Now, if we do the math right, you can see right here that they did 230 million in the previous quarter, 190 million in Q2. So it's very likely that the full year weight loss guide is going to absolutely be obliterated. They're going to smash their weight loss guide, assuming they don't get like litigation from HIMS or Eli Lilly, which I think is definitely coming down the line. But I think there's definitely upside to their guidance figure. If that is the case, because, you know, they're guiding very, very conservatively here for weight loss. But again, a lot of risk is tied to the weight loss scene at the moment, especially with compounding and what's happening with that. Something else to note from their earnings call, they acquired the company called Zava. It's pretty much what HIMS right now is in Europe. So they acquired Zava for $265 million in an all-cash consideration, upfront payment of $147 million, and then there's earn-out potential of up to $118 million. And what's really interesting to note about the Zava acquisition is that for the rest of the year, this is actually going to be revenue accretive of $50 million, and it's going to have a positive adjusted EBITDA margin. That's very, very interesting. So, you know, they're paying $265 million upfront. They're going to get access to the European market, and this is what their market looks like right now. So they're probably going to get into the mental health space in Europe as well as longevity. They're probably going to expand their TAM in the Europe segment, which has 160 million users. So it's a big big user base right here for Europe. And you can see in the United States, there's 250 million people. They're expanding into Canada, and they also announced that they're going to be entering Latin America before the end of the year. And Latin America could be a huge growth driver. Europe is going to be another big growth driver. And America still has stuff like hormone health and longevity. That this green tick means that they don't sell it yet, but they've been approved to sell. This gray means they don't actively sell it, but they are open to entering these certain markets right here in Europe. So very, very interesting. This is a company that's also expanding globally. So growth for this company can continue. Now, there are some things I didn't like with this quarter. I think the biggest thing for me was actually like their total debt. Hims is always a company that didn't have a lot of debt. Up until last quarter, they had $63 million in debt. They now have $1 billion thanks to the Zaba acquisition and a couple of other things, just expanding. So look, it's not a crazy amount of debt and they have the cash to offset this. However, interest expense going forward will be a big thing, and that is going to drag on margins compared to the previous quarters right here. But for a growing company that has an extremely high ROI like Hims, you want the company to take on debt and you can deal with the interest expense a little bit later on. But just something to note, right? This isn't a company without any debt anymore. They do have a substantial amount of debt on their balance sheet. Now, let's actually talk about the valuation and the consensus 12-month estimate targets, right? Hims looks fairly valued. The average analyst has a hold rating, a high of 68, right? Which is pretty much where the stock traded before the earnings. An average target of about $40 and a low target of 26. So you're looking at like 40 to like 70% drawdown at the low end right here. So the street kind of bearish on Hims as a whole, and for good reason. You can see that the stock is not cheap at all. It trades at a 38 times forward EV to EBITDA. It trades at 53 times PE, but it was trading at about 20 times at the tariff tantrum lows. So this is a stock that only recently has gotten fairly expensive. Before, the valuation was actually pretty reasonable and has a shareholder yield of 0.73%. I think the stock buys back. I think the company buys back a little bit of its stock, but they're still dilutive to their shareholders. They dilute shareholders by about 5 to 6% every single year. And I do expect that to continue into the foreseeable future. Now, looking at the overall valuation and what are the returns we can expect, plugging in the trailing 12-month revenue, right? Growing to $6 billion, which is what management is guiding for by 2030. And we're using 5.9 by 2029. It's about a 24% compounded annual growth rate and margins expanding. Net income margins to 18%. You're looking at about $1 billion in net income by 2029. Now, using a 40 exit multiple, which is steep in my opinion. The current multiple is 80, so you're seeing margin contraction, but it's still very, very steep. You're looking at an enterprise value of about $42 billion. Then you subtract the net debt, you get the equity value and divide by shares outstanding, again, increasing sequentially by about 5%. You get a stock price in 2029 of $69. The current price is $54. So you're looking at about a 4% compounded annual return with a fair value of about $40. So is Hims a buy right now? Absolutely not. It's too expensive. You can never bet on a 40 exit multiple and really frothy estimates with margins almost doubling into 2029. This is the absolute bull case scenario. Everything goes perfectly according to plan. And to be honest, I just like a little bit more margin of safety in the stocks I buy. That being said, I like the business. They're executing. This management team is great. And Hims continues to do what Hims does, and that is grow and blow out earnings. And look, revenue guide didn't come out as expected, but there's nothing wrong with the underlying business. It's a great business. It may have some legal issues on the way, but for all intents and purposes, as it is right now, this quarter, I like the business, just a bit expensive. But guys, if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.